Good morning, good afternoon, good evening, everyone. This is Joseph Trevisani from Worldwide Markets. Welcome to our webinar today. Yet another discussion of the effect of the election of Donald Trump, and we will see how that goes. Which is just so you know, anyone who's not an American, the inauguration is this Friday. It should be interesting. Hold on one second here. Hi, apologies everyone. We had a little bit of noise outside. I thought I'd see if I could quell it. As always, I have chat notices up here. So if anyone has any comments or anything you'd like to add to the webinar, please do so. I'll be glad to stop and explain anything that I'm talking about at the moment. Especially this is for, in this particular webinar, it's a notice to non-Americans. If you require or desire any elucidation of what may seem to many people from overseas a rather peculiar election and electoral system, I'll be glad to provide it as long as I can ask questions, as we have a number of elections coming up this year, which may actually, in Europe, which may provide equally interesting results. Of course, I'm speaking of the French election, the German election, the Dutch election, and the potential Italian election, all of which, as should be the case in democracy, have the potential to reshape the political dispensations that we are living under. And that's certainly what's happened here in the United States with the election of Donald Trump. Okay, so what are we talking about here? Well, let's take a look. Let's take a look at the primary. I'm putting these up on one chat channel here, and then I am monitoring the chat. So if anyone has any comments, just type right in. This is the Dow Industrial Averages, which I'm using just as a representative. What we have seen since the election, the first blush, has been a powerful 10% rally, 11 if you will, percent rally in the equities. We've seen a powerful yield rally, although of course a price fall in treasuries, in bond yields. And we've seen the continuation of a rally, which really goes back about a year, in commodities. The commodity rally, it would be tough to trace directly to the election, but certainly the election hasn't hurt it. The equity rally is specifically tied to the election. That date on the bottom left-hand corner of the rectangle is November 4th. That's, of course, the Friday before the election. And the left-hand corner is where we closed last Friday. So this is specifically related to the election. Let's look at the 2-year now. I want to get the right one here. Okay, this just to give you a sense of what we're talking about as far as some of these long-term movements in various U.S. markets. This is a chart of the 2-year. No, I'm sorry. This is a chart of the Dow going back to the recession. What I wanted to impress upon everyone is that this recent movement that we've seen post-election in the Dow is absolutely within the trend of the past 8 years, seven change years. has not broken the trend channel. It is well and comfortably within the trend of the larger part of the past decade. The thing that we have seen is this little movement right here. This was the prior top here back in the middle of 2015, and that was the subsequent top here in the middle of 2016. They're not very far apart, actually. But this move is, in a historical basis, unprecedented. But on a trend basis, hardly. The one thing we need to remember about equities is the trends in equities are almost irrevocably higher over time. And that's because the size of the equity markets reflects, and the level of the equity markets reflects the size of the economy. The economy grows, equities go higher. So there is, as you've heard, I'm sure, many times in analysis, an inherent bias in equities towards the upside. So this particular 10% run up, which is a very powerful move. I mean, it took place in 2 months, basically. Actually, 1 month, a month and a half, from November 9th, really, to, I believe the top was on December 15th. It's a little bit, it's 7 weeks, basically. And since then, it's stabilized. So let's take a look at what we've seen since then. Which one is this? That's 2-year. We're going to deal with the here we go. Okay. This is industrials post election. Okay, you can see that the old high of 18,351 went back here, that the subsequent high this year in the late summer was 18,668, and this is the substantive move right here, as you can see. That's November 4th, the day before the election. So that's the response of the equities. And we've essentially lost about 100 points from the top, although I believe the futures were down again this morning about 40 points before I started. So this is the move that the equity markets are telegraphing to us. Now, we know the old line about equities getting it wrong, they predicted, and everybody else. Prognostication is an insecure art, which is why there's always room for new prognosticators, because anybody who's even reasonably good at it gets it wrong, and then there's room for someone else to come in and have their own say about what they think is going to happen. But this is a fairly concrete avowal by the equities, using, of course, the industrials, the Dow Industrials, as representative. Now let's take a look at what's been going on in commodities. Now, there's pretty much no way to really give this as nearly a ringing assent as the equities did. The commodity rally has essentially been going on. This is just using the Bloomberg commodities index. By the way, all the charts are Bloomberg. The commodities rally has been going on basically for a year. It doesn't mean that there's been an insubstantial move in equities. I mean, in commodities. It's not. It's, as you can see from the day before the election, from this chart, you can see it's 6.3%. But there's a lot that else is going on in equities, I mean, in commodities as well. And primarily, we're talking about the OPEC agreement with Russia and other non-OPEC oil producers to drive up oil prices. It has succeeded somewhat, but whether it works long-term or not is very much open for debate. There have been numerous attempts at agreements in the past, many of which have faltered to some degree on cheating by various members. In addition, there is a new and very powerful, and I believe will turn out to be dominant force in the markets. That's, of course, shale oil technology, fracking, and here in the United States and in Canada. depending on where the bulk of that type of oil is profitable, you can be more than assured that North American producers will produce to that level. So whatever, if shale oil producers, and it's kind of hard to get a hold of this because they're individual oil producers, but say shale oil, it's my feeling that shale oil, there are enough shale oil producers in the United States and Canada that are profitable at 60 or below, that's the effective cap on WTI, and a few dollars a barrel higher for Brent crude, which the rest of the world uses. I've had some discussions with a friend of mine who specializes in oil. We don't necessarily agree on all of this, but this is my view, that this new development, and it's an astonishing new development, will cap the oil prices for the foreseeable future, since whenever they rise above, or there can be very little price effect. The only thing, of course, that will be at play here is the amount of time to bring shale oil on market. It depends how the shale oil market works, and also how the technology works. I'm not an oil technician, although I have worked construction many years ago out west. I was not a roughneck. I did not work on oil rigs, although I know people who did when I was right out of college. So depending on the number of wells that are actually capped, meaning they're not being pumped at the moment, that can be brought back online, but I think that's relatively small. I think you're talking mostly, once a well is pumping, it tends to stay pumping because the marginal cost to produce is minimal, and the sunk cost can still be recovered, whatever the price is, to whatever degree that permits you to pump oil. So most wells that are drilled and brought online tend to stay online, and that makes perfect sense. So the question is the development costs for new wells, or the development speed. Again, I had this discussion with a friend of mine, and he said that it's down to a couple of months now, maybe 3 months. So there can be a very, very quick reaction in the oil market. So all of that is playing here in the commodity market. But again, another aspect of this is that the commodity rally, although it certainly predates the campaign and any hint that Mr. Trump would be the president-elect this week, and the president on Friday, I think about 10 o'clock in the morning, the rally has continued. And 6.3% is a pretty substantial move in the commodity index over a little more than 2 months. Okay, so now let's look at the interesting stuff. This is, oh no, sorry, that's the wrong one. Sorry, it's industrial. Let's get the 2-year here. So let's put those together so we know where they are. There we go, 2-year. Okay, this is historical context. This is the 2-year in the blue and white candles. The 10-year, these are both generic yields here in the United States, in the green, and the Fed funds rate in yellow. And what you can see is the degree of correlation between these three rates. It's astonishingly high, as you would expect. Remember, 2-year here, Fed funds yellow and green. We're looking general trends here. So the other interesting aspect, of course, of this chart is timing. The commercial rates, the market rates, tend to move first. There's no surprise in this. As soon as you get a hint from the Fed that something's up, the markets go to town on it. And they move quickly and they move very dangerously, shall we say. Okay, so this is the correlation. And it certainly looks from this as if anticipation of the Fed moves are driving rates. Of course, just looking at this chart, you would say the opposite. You would say that market rates are driving the Fed. We're not buying that. But in fact, I think what's happening here is that both, well, not I think, what's happening here is that both rates are keying on perceptions of what's going on in the economy and what's necessary. The Fed looks at the market, at the economy. The commercial rates look at the economy and they look at the Fed, and then they anticipate what the Fed's going to do related to the market. So all of these are actually, all three of these rates are actually referencing, I think, a third item here. Okay, so, but there are prolonged periods. Let's look at the 2-year here. This is the 2-year post-election. 2 years closer to the Fed funds rate, of course, than the 10-year, although the 10-year has more commercial significance, meaning that all sorts of market rates are keyed on the 10-year more than the 2-year. You know, car loans, things that have longer term prospects as far as the period for payback goes. So this is what we have post-election in the 2-year. We have a powerful 49, almost 50-point rally, basis point rally in the yields from November 4th until now. That was, in fact, a 60-point rally to the top, which I believe is December 15th, and then a retrace back 11 points. Not a substantial move, but not an insubstantial move either. So the question we have to ask is what's being reflected here? The easiest answer, of course, well, dude, there's profit taking here. And that's a very likely answer. We've only had about a month's change, change in the prospects and the recovery of prices in the bond market. And what we've seen in that period is not very much, frankly. It sounds a bit funny, but that's true. We haven't really seen any change in the complexion of economic statistics that have come out of the US economy to bring upon a reversal in the attitude of the bond market towards the election of Donald Trump. Okay, so let's take this. Let's now look at the 10-year over the same period. Where's my 10-year post-election 2-year? Here it is, 10-year post-election. Okay, here we go. So this is the 10-year post-election. We've seen the same thing. We had a powerful rally in the 10-year yield, and then a retracement of about a fifth. So all of these equities, commodities, and particularly credit. Now I'm focusing on the credit markets as the leading indicator in this particular analysis set. And the reason is because it's generally true. The credit market has a both reputation, which I believe is factually based, in a more rigorous set of analysis because of the nature of its business. Bonds look at long-term yields, they look at long-term prospects, and they are forever reassessing, less emotionally, if you will, the attitudes and the intersection of the economy and rate attitudes coming out of the Fed. In addition, the bond market tends to be a lot more market-oriented. It's a lot harder for individual investors and retail investors to play in the bond market. The only way you can really do it is through bond funds, and bond funds are not a particularly good way of investing in the bond market, because what you do is you risk capital in a bond fund. Whereas if you invest in a particular bond, you do not necessarily risk capital. You risk return. You put your return at risk, but you don't necessarily put your capital at risk, because you can always hold the bond to maturity. And if you stay shorter, then you are tending to minimize all of your capital risk and loading all the risk on the interest rate side, which, as a conservative investment, as a conservative investor in my own personal life, is a very sensible way of handling a certain portion of your income, of your investing attitude. So the attitude of the bond market tends to be, if you will, more rigorous. So the question we have to ask, as far as the two bond charts that we've looked at, is what is causing this reversal in yields? It's not an insubstantial reversal in the yield. It's 24 points in the 10-year and 11 in the 2-year. Is this indicative of reality reasserting on the election side, meaning that President-elect Trump's policies will either not be enacted as readily as one might have anticipated, or they will not produce some of the results? Certainly there's nothing being generated as far as economic statistics. It really has any relevance to this, simply because nothing's been enacted. Trump's not even president yet. He will be at the end of the week. So we're going to try and disentangle here, and in a moment I'm going to start talking about some of the policies and the likely results. But what's depicted on this chart, and I think all of the charts that we're looking at, although less so the commodities, certainly the equities chart and the bond yield charts, is the surprise that was announced on the evening of November 8th. If you, as a participant, as a bond trader or portfolio manager, and you as a equity portfolio manager, had arranged your portfolio in the weeks leading up to November 8th, there's really only one thing that you could have done. You would have structured your portfolio for a Clinton victory. Nothing else would have made any sense. You may have gone less strongly into the position, but nothing else would have made any sense. I mean, I myself wrote before the election that it's very difficult to gainsay the polls. I will say that I went on after that to say, but I think that the chances of Donald Trump being elected are far higher than are anticipated in the media or predicted by the polls. And I did believe that, and that definitely turned out to be true. But I did not predict a Donald Trump victory. There was almost no one in the markets that I know of that did. There were a few outliers. Doug Adams, who writes the Dilbert cartoon here in the United States, was one. Michael Moore, sort of the leftist provocateur and filmmaker, was another. Although he didn't predict it, he said it's quite possible. So except for a few people outside of mainstream finance, mainstream media, nobody was predicting a Donald Trump victory. So that's the attitude that goes into the equity, the levels that we're looking at. So part certainly of the move here in yields, opposite in prices, and in the equities, is a reaction that was necessitated by the repositioning of portfolios. So we're talking about a degree of change in the portfolio in this run. Let's bring up the equities again. So we have, because that's more specifically, where's my Is this one? Yes, this one. Here we go. Okay, that's equities. That's the Dow post-election. The interesting thing down here is, look at this. This entire period in September and October is during the anticipatory phase for a Hillary Clinton presidency. Nobody seemed to be terribly enthusiastic about it, just judging by the levels. Nobody was going out saying, you know, if Ms. Clinton wins, it's going to be great for the economy, because otherwise they'd be buying stocks, and they weren't buying stocks. It's here. This is the down, the reversal, and the FBI thing, but we can pretty much ignore it. This is what's important. And as the election became the focus of both markets and the population here in the United States, after the summer vacations, meaning September, October, and very early November, there was no great enthusiasm in the markets, judging by the price levels, for a Clinton presidency. The assumption was being that a Clinton presidency, as far as economics, regulatory, and all of the other policies we're going to talk about in a minute, would be nothing more than a continuation, would simply be a continuation of the Obama administration, 2 terms, which have not been terribly prosperous years. I am not trying to either minimize or criticize or promote a particular political view. I'm simply stating the facts that the economy did not grow very strongly. Wages were largely stagnant through the period until the very end. And you didn't get a lot of movement in the markets because of that. Let's take a look here. That's not the one I want. Remember, this is what we're talking about. This is essentially the Obama presidency. Not quite, but very close. Okay. And from this, you've seen this is a powerful rally, probably the most historical rally in equities in history. So based on this, you would say the Obama presidency was absolutely wonderful for the US economy. There are too many other factors involved here. It's very difficult to disentangle how much of this was portfolio management based on lack of alternatives and very low interest rates. But judging by other standards, the Obama presidency was adequate. It wasn't a powerful economy as would have been depicted by this, because if you look at GDP, the average is around maybe a little bit more than 2%. At no year, although quarters, yes, but there was no year in the past 8 years where the US economy averaged 3% or more. I believe that's the first time that's ever happened in history. So despite the appearance from this particular chart in equities, the past 8 years were not a boom time here in the United States. I am not arguing cause and effect. I'm simply presenting facts. So that this cannot be taken, this chart cannot be taken as a particularly pointed or poignant view of the US economy. Okay, so let's look at this again. So again here, one factor in this as a market rally is separate from the advent of the presidency of Donald Trump, which happened on the 8th. It's a repositioning of markets, equities, and all markets essentially for a surprise event. Now, it's impossible to disentangle how much of this is simple surprise and how much is positive reinforcement. Certainly, it's true that if the markets had not viewed, even if prior to the election they were not buying based on it because they didn't expect Mr. Trump to win, it's self-evident that the market view of Trump policies was that they'd end up being good for the economy. And so that is here. And there's no other interpretation possible. You can argue with it, but you can't argue with the fact. You can say, no, the markets are wrong. Trump's going to be terrible for the economy because he's going to blow up the world or something like that. But you can't argue with the fact that equity traders, equity portfolio managers, the equity markets as a shorthand, that's not their view. This is their view right in front of us. So what we've seen here, and the best way to look at this chart is to say you have both repositioning, because my guess is had the Trump victory seemed more apparent through this period here, you would have seen more of this. You would see a slow upward slope back here. The stasis back here is noting two things. Clinton was expected to win, and Clinton would be a continuation of the Obama administration, which has not had the policies which have not had a terribly beneficial effect. At least there's no strong growth here in the United States. Again, there is a serious difference, and I want everyone to note this in analysis, between stating what appears to be facts from a chart and using these facts to then support a particular political opinion. I am doing the former, but I am not doing the latter. We all have to keep that in mind. Every time I have discussions, I live in Manhattan, which is not a Trump area. I haven't seen the returns from Manhattan where I live, but my guess is we're talking 85% and up, at least 80% and up, voted Democratic for Mrs. Clinton. So I get into a lot of discussion, shall we say, in various venues, social and otherwise, about this particular topic. And many people will take offense when I say something like the economy's not been good, relatively speaking, to past eras under the Obama presidency. This is just a fact. I mean, U.S. economy's grown about 2%, 2.3%, 2.2%, something like that on average, which is historically very, very low. Wage growth has been very low. So there are a number of things here which actually go into analysis that are simply not in line with previous eras. And I get routinely accused and attacked and everything else. And it's very difficult for people, apparently, to listen to a rendition of empiricism and not assume that there's a political bias which is promoting it. And I try very hard not to do that, especially in my professional work. Okay, so back to this. So this chart is both a recognition of that they were wrong and a relevation, as in the fact in revealing a different opinion that was constrained by the voting, the potential voting back here as depicted by the polls. Even if you were a big believer, and were a big believer in before, that the sort of the sociological and psychological facts behind the polls were very powerful, it's very difficult to believe because you don't have any facts behind. The polls come out with numbers, and you're saying no. If this is your belief, they were wrong about Pennsylvania. They were wrong about Michigan, and they were. Polls are off an enormous amount. They were not capturing something because they were wrong. But to present that as an argument without factual basis is very difficult beforehand. So, as I've said several times, if you're the professional, your job is to invest in the market and make decisions, you pretty much have to go with the polls. I mean, the best you're going to do is what you see right here, is that even if you are wary, and if you are wary, you're simply not going to commit. And that's, I think, what we're seeing here. So we're seeing both a assessment of missed chances, wrong, as in wrong in the assessment of who's going to win the election, and a release, if you will, of more positive sentiments based on Donald Trump. And so that's the run. It's been pretty much a 10% run. Powerful value, but not necessarily a trend. This is a rally. It's not a trend. This is a trend. regardless of what we're basing it on, this is a trend. That's a trend you can make money at. From 70, whatever it's 7,000, 16,800 down here to 19,000. That's a trend you can make money on over 10 years, or 9 years, 8 years. That's a lot of money. That's a trend. What we're seeing is a rally. And it's a rally which may or may not prove to be a trend or the beginning of a trend. So the things that we've seen so far and we've looked at here so far. Equities have had a powerful rally. We're going to discuss why in a minute. Bond yields have had a powerful rally. They've given back a little, about a quarter, a third, between a third and a quarter, between a fourth and a fifth, actually is more correct. And commodities have a rally, but the rally both predates the election and simply has not been changed by the results of the election. Okay, so those are the market facts that we have in front of us. So what is it that the markets are seeing in a potential Trump administration? At this point, it's not potential. It's real. It will be on Friday. So what are they seeing in what areas? You know, there was a lot of talk. So now we're going to look at some of the reasons, the economic assessment. We don't know. We haven't seen anything yet. Nothing has happened. Mr. Trump will not be president until Friday. What happens thereafter, we don't know. We'll see. But anyway. So what are the potential differences between the incoming Trump Republican control of Washington, the federal government, and the outgoing, originally in 2008 through 2010, actually 2009 and 2010, he was inaugurated 2009, Obama Democratic rule in Washington. Because remember, when President Obama was elected in the fall of 2008, at the height of the financial crisis, the Democrats that January, when he took office, controlled all three branches of government. They controlled the House, they controlled the Senate, and they controlled the presidency. That lasted for 2 years. There was an enormous reversal in the House, something like 64 seats or something, historic in size in 2010. And the Republicans have controlled the House since then. So if you'd like, and use the term, which is vastly overused, I will not call it a mandate, but in power, it was essentially a mandate, lasted for 2 years. And the results of that 2 years politically have really determined the rest, the subsequent 6 years of the Obama administration. And the policies that we've seen are the policies that the market anticipates will be reversed to a very large degree because of the current makeup of the, I mean, this is a rather astonishing switch in 8 years. Again, as little judgment of my own enters into this as possible, but I am making the point that in the democracy, and this is a democracy, it's a federal republic, but it's also a democracy. When you have results like this over a period of time, you are seeing the sense of the population. If you don't agree with it, you can deny it, but it is inescapable as to what this actually means politically. And we're about to see the results. So the reason I harp upon this, dwell upon this, is because that also is evident here in this chart. The markets are anticipating something. So let's take a step back. What are the markets possibly anticipating? Well, there was a great deal. This means from the administration. I think you put it into basically three areas. There was a great deal of talk, although you haven't heard so much about it lately, of some sort of economic stimulus here in the United States. I think that'll probably be scaled back, but you'll get something. I don't know how much. I doubt it's going to be $1 trillion, but you'll get something. Government spending produces a burst of GDP growth. Inevitably, it has to. The second is there is no question that the current administration has been very active in the regulatory sphere. They've been regulatory on the financial side, starting with Dodd-Frank. They've been active in the health field with the Affordable Care Act, also known as Obamacare. They've been active in environmental legislation, excuse me, in environmental regulation. Again, many of the things that have transpired have happened because the Democrats lost the House in 2008. Things which might have been passed as legislative acts and much harder to undo were stymied by Republican control of the House. This is, and will I think be viewed historically, as the crucial fact of the Obama administration. Because everything that has followed makes it far easier for a different administration to undo. Some of it will be much harder. Dodd-Frank will be much more difficult to repeal. Obamacare will be difficult to repeal, but hardly impossible. All of the regulations, both business and environmental, that have impacted various markets and various businesses are essentially able to be undone with, as Obama used to say, a pen and a phone. So part of the response you're seeing to this chart, or the result of this chart, or I'm sorry, the reasons behind this chart is exactly that crucial fact from 2010. There is simply no way to interpret that election as anything but a rebuke to the party that was then in power. There is simply no, you can say anything you want about it, and I know this will in many quarters, and where I live, of course, be enormously controversial and subject to all sorts. I just had to, my sister and I have agreed, my sister, we have agreed on peace. Over politics, we're not going to agree. But there's no other way to view that as in a democracy and a republic, as a rebuke on the prior 2 years of policy decisions by the Obama administration. And everything that's followed stems from that crucial fact. That fact, that election, which was largely driven by grassroots activism in the United States, is the second most crucial fact of the history of the Obama administration. The first is that he got elected. Although you could say that prior to that, of course, is the financial crash, which enabled his election, aided his election, shall we say. I don't know if it enabled it or not. And the second most important one is that 2010 House election. So the market response to this is possibility, meaning that a lot of the things that businesses and business people think have inhibited their performance over the past number of years will be rescinded relatively simply. Another fact of the politics behind this is that Mr. Trump does not come to office with any particular political ideology. Mr. Trump, which everyone that where I live, seems to ignore, is the first president from New York State, New York City, since Franklin Roosevelt. Although Franklin Roosevelt did not grow up in New York City, he of course is from upstate New York, Hyde Park. His family seat, as they used to call it in those days. Fascinating place to go, actually. It's right up the river from the city. There's an enormous amount of American history up and down the Hudson Valley, and it's the kind of history you don't have to read about in books. I mean, you can, of course, and you should, but the houses exist, and most of them are open to the public. So there's an enormous sense of history and how place and birth can shape your view of politics and history. Anyway, we take the kids to all of these places, and they're actually quite interested in them because they're studying, even though they're only 8, they're reading about American history. One of my girls came to tell me at dinner yesterday why Frederick Douglass, the writer and freed slave, I believe, from the latter part of the 19th century, spelled his last name with 2 S's rather than 1. Douglas is usually spelled with 1 S. He spells it with 2. And she said because he wanted everyone to know, my 8-year-old, that he was this Douglas. And so he put 2 S's on his name. Great writer, by the way. Great thinker. So, Mr. Trump's approach to politics, I think, is being judged by the markets as far more performance-oriented and far less ideological than the current administration. And being as a performance bent, the one thing that would appear to be key to success is a focus on economic growth and wage improvement for Americans. Well, if that's going to be your goal, again, some of this is a little distant from the pronouncements of the president-elect himself. But I believe, market judgment is that the focus of the administration is going to be on actually doing things that can be referred to. And there is nothing, I think there's very little question that Donald Trump owes his election to a sense of economic disenfranchisement, actually ugly word, of economic malaise, not much better word, of economic angst, not better, we're still working for the right word, of a decline in economic prospects for a large portion of people in the United States. People who were motivated enough because of that to vote. That's what got Donald Trump elected. Despite all of his other foibles, all of the things that my sister doesn't like, Mr. Trump was elected here in the United States. And so the economic performance of his administration is going to be key to everything else. So taking that view, and that view both of the president-elect and the Republicans who have more of an ideological affinity for these types of policies, the view of the markets is that the focus on economic growth, on jobs, on bringing jobs back to the United States. I don't know that bringing jobs back, that's the high-profile media way of looking at it. My view is that the administration and the Republicans in Congress will do more to enable, meaning that you can promote U.S. factory jobs, which is essentially what we're talking about, with all sorts of positive government policies without simply trying to put on tariffs here in the United States. After all, businesses are going to make their decision based on profits. And there are many things that can be done to enable or to promote that type of economic growth here in the U.S. I'm not saying that that type of economic growth will, or that degree will trump the enormous differential between wages in places like India and China and others, Vietnam and the United States. But there are certainly things that can be done, many things, that can make this a more, if we say, difficult decision for U.S. firms. I mean, one of the things is, although it's cynical to look at it, one of this is the thing certainly is a more fraught relationship with China. And contending some of the Chinese political moves in the South China Sea is one way to do that. So there are a number of factors here, but all of them point in the same direction. That the trend of the U.S. economy, at least for the next year or year and a half or even 2 years, is going to get support from the administration of Donald Trump and the Republicans. I mean, one of the things, just take an example. So it's one of the things, example, the EPA regulations on coal. The Obama administration has a great belief in global warming and that it's man-caused and that coal and fossil fuels are bad. Without arguing the merits of the case, these types of very powerful regulations simply are not laws. They're simply passed out of the EPA. What's her name? McCarthy, I think, was the head of the EPA under this. Well, they can be rescinded almost as easily. So the aspects of Obamacare that mandate full-time, wherein you have to provide benefits at 30 hours. So what happens? Well, it economically pressures firms to have many more part-time workers. What does part-time workers mean? Well, they don't have as much money to spend, and so they don't spend as much. You look at retail sales, you look at any of the consumption figures out of the U.S. post-financial crash, and they're way below par. What are small percentages across nationwide statistics are huge absolute numbers. So these things can actually be modified relatively quickly. Let's look at one or two more things and then we will end here. Okay, this is the biggest move and retracement. This is the 10-year. So the question we have to ask, and what I asked in the write-up of this, is this, one, the leading indicator? Is this essentially the buy the rumor and sell the fact chart that is going to eventually, sooner probably rather than later, be applied to all of the other charts? In other words, if we have a powerful yield rally and then a fairly powerful retracement. Is that buy the rumor and sell the fact? Meaning that we are not going to get the performance out of the US economy vis-a-vis the administration of Donald Trump and the Republicans in Congress. So that this move, this reversal, will soon infect the Dow. We haven't seen it so far, of course. It's been a month almost, and the Dow has just been tooling along pretty level. And commodities certainly have not retreated either. So that's our question. And it's the primary question for this webinar. Is this a leading indicator? In this case, I will tell you, I do not think it is. I think that we're going to get enough movement, regulatory, stimulus, legal changes, legislative changes. In the first 6 months of the current incoming administration, that will provide the U.S. economy with some running room to move. The U.S. economy is large enough and autarkic enough, although it's certainly not an autarky. That means economic growth and movement inside the economy. You don't do a lot of, there's very little connection to other economies. The U.S. is that way more than almost any other economy because of the size of its market and the wealth of its market. So you can get long-term, no. If the rest of the world is growing minimally or in recession, the U.S. cannot maintain a very healthy growth attitude. It just doesn't work. But we're in a mixed period where you have neither one nor the other. The world economy is not growing very strongly, neither is the U.S. Reasons are intertwined. Reasons have to do with politics. The British, the Dutch, the future of the EU, the future of the euro. What is China up to? What are China's real statistics? What is the real economic picture within the mainland? What are China's political ambitions? There are all sorts of things involved here. But the anticipation of the markets and in market pricing, I think, is based on enough potential. Now, again, this is potential reality from the incoming administration, that this simply buy the rumor and sell the fact is not going to be the long-term, meaning 6 months or a year, view of the markets. And remember, whatever the incoming administration, along with the Republicans in Congress, do, the economic effects will be months, if not years, down the road. So the next 6 months, not completely, but to a greater degree than most other periods, we will be trading, observing, and drawing conclusions based on political acts and actions out of Washington, D.C. It's going to be a number of months before the first statistics even start to come back that you can say are reflecting or the actions of the administration and Congress. So we're going to be doing much more of this and what you saw in the Dow. We're going to be trading on anticipatory economics from political actions of the administration and the Republicans in Congress. So we have, I think, another 6 months of very active political market and economic speculation. Okay, thank you very much for attending, everyone. I hope this was useful. I hope for our foreign clients and friends that this was some help in understanding the what's going on here in the United States at the moment. We will have another webinar next week. I have not chosen the topic yet, although I do have a few requests from last year, which I do intend to fulfill. So again, thank you very much for attending. If you have any comments, you can send me an email and I'll be glad to answer. Everyone have a great day and thank you for attending.